Okay, so again, I think I have already presented my screen. Okay, so this is Accounting 9, Auditing and Assurance Concepts and Applications. We'll be talking, of course, about auditing and assurance. In, in your knowledge, or as far as you could understand, what do you think of when you hear the word audit or auditing and assurance? What can you think of? You can just drop your answers in the chat box so I can read them, or you can open your mind. Just not together though. Anyone? It is a systematic process. Okay. How about the others? Thank you, Pauline. What can you think of, or what comes to mind when you say auditing and assurance? Expressing auditor's opinion. Okay. What else? Evaluation. Mhm. How about the others? What do you think of, or what can you think of, or what comes to your mind when you hear the word audit and assurance? It lends credibility to the FS prepared by an entity. Okay. Inspection of books and physical checking of inventory. Examining and evaluating financial records. Evaluation of companies' financial statements. Okay. All right. So um, for the whole term, we'll be discussing audit and assurance. So this will be both concepts and applications. So at some point, we'll be having some cases, and at some point, we'll be discussing some theories regarding audit in such a way that you will also understand how things, or even be familiar with the terms that we use in audit and assurance. Okay, thank you. Auditing is conducted objectively, conduct the audit without bias, enhances the value and usefulness of financial statements to evaluate and assess financial statement. All right. Thank you. Pauline, Reno, Jean Mary, Claire, Yanis, Natalie, Shenzi, Pearl, Anna Lou, and Lai. To evaluate and assess the financial statement. Okay. All right. So let's go through the topics for today. Okay, so we'll have risk assessments and internal control, because when you say audit and assurance, it includes risk assessments, and of course, we'll be looking at internal control. Okay, so risk assessment procedures are performed to obtain an understanding of the entity and its environment, including the entity's internal control, to identify and assess the risks of material misstatement, whether due to fraud or error at a financial statement and assertion levels. So, as an auditor, you are going to be equipped, or at least should be equipped, with the skill of assessing risks. Your mindset, or at least you begin with a mindset or a question to yourself when you're assessing what could go wrong. Okay, that's why you say here, assess the risks of material misstatement. Okay, of course, when you studied, maybe in your first year or when you first studied accounting, you hear the word materiality concept. So when you say materiality, we are more focused on what matters. Okay, what could affect the decision of the stakeholders in relation to the business, especially to the financial statements. Okay, the attestation of the financial statements as far as the management is concerned. So, as an auditor, you will be looking at the risks of material misstatement. Could there be anything that could go wrong, okay, in the financial statements level or in the assertions level? Okay, so in assessing that, you would of course examine the internal control existing in the business, okay, in the risk assessment. Of course, it's better if the company has a well-established internal control. It helps reduce the risk of material misstatement, but you cannot entirely eliminate the risk. Okay, so risk assessment procedures include the following. Okay, inquiries of managers and relevant stakeholders, analytical procedures, observation and investigation, discussing engagement with the team. Other risk assessment procedures would be the risk assessment procedures are designed to enable the auditor to obtain a thorough understanding of the client's business and its environment, specifically the internal controls, the purposes of understanding the risk of material misstatement in the audit planning process. So the procedures do not provide persuasive audit evidence to form an audit opinion on the financial statements. So in the risk assessments, um, these statements will these procedures will be uh, followed or usually done when you do this um, risk assessment. Okay, and that usually includes the inquiries of managers and relevant stakeholders. Okay, um, so for inquiries of managers and relevant stakeholders, the this provides the auditor the knowledge, okay, in order to understand how the business works, how the business actually operates, because you will only be able to assess the risk of the organization in terms of the flaws maybe in the internal control if you are actually you actually understand how the business works. So it's important that you it's usually always done to have inquiries of managers and relevant stakeholders. So just very recently in an audit that I have conducted, we need to go to the site or visit the office of the client and actually interview the manager, interview all the other staff involved in the operation of the business, and that gives you an idea how each of the members of the team in the organization works and what could there be some cracks or what could possibly go wrong in the process. Okay, so assessment of the internal control is also there. Another procedure to be done would be analytical procedures, especially if you have enough knowledge in the industry. You will look at the financial statements or the reports or the data presented to you by the management, and the management can or you as an auditor can actually perform analytical procedures. Maybe compare it um, with the other companies in the same industry operating the same business. Okay, especially the levels and percentages. You can do your horizontal or vertical analysis, and in doing so, you will be able to notice some discrepancies or variances that may uh, point your attention to further investigation or queries with the management or with the operation. Observation and investigation is another way or another thing to do when you are auditing. You also observe how people work, um, how they actually conduct the business. and that could give you an idea what could go wrong. Discussing engagement with the team is also important procedure because the team should be synced in such a way that they will come up with a very good and comprehensive assessment of the risk for the organization of the client. And other risk assessment procedures can also be done, okay, relative to the industry or to the business, or depending on the type of business that you are auditing, right? So the risk assessment procedures are designed to enable, again, the auditor to obtain a thorough understanding of the client's business and its environment. Okay, so specifically the internal controls for the purposes of understanding the risk of material misstatement. Okay, the procedures do not provide persuasive audit evidence. What does it mean? That when you do these things, these are not yet substantive procedures. This will not provide evidence, but this will give you an idea, or this will allow you to plan out what are the courses of action or what procedures, audit procedures you're going to perform after you have conducted your risk assessment. Okay, so we will further discuss this as we go along in this subject. So, as I mentioned earlier, these are substantive procedures. Okay, substantive test procedures. These are substantive test procedures are audit procedures designed to detect material misstatements at the assertion level. Okay, so assertion level, those are really to specific documents that you can actually observe or actually note. Okay, as a misstatement. Okay, so, and we also have tests of controls. Tests of controls are audit procedures designed to evaluate the effectiveness of controls in preventing or detecting and correcting material misstatements at the assertion level. Okay, so when you say test of controls, of course, it is imperative that there is control in the company, right? And then we also have to know that there is a business risk. What is a business risk? It is resulting from the significant conditions, events, circumstances, actions, or inactions that could adversely affect an entity's ability to achieve its objectives and execute its strategies, or from the setting of an appropriate objectives and strategies. So this is the business risk as a whole. The auditor does not have a responsibility to identify or assess all business risk of material misstatement because, again, we have a limited scope of work when you do the audit. And the most common would be the financial statement audit. So we will be just focused on the fairness of the presentation of the financial statement. But there is what we call that exists the business risk. Okay, significant conditions, events, circumstances, actions, or inactions that could adversely affect an entity's ability to achieve its objectives and execute its strategies. So everything that could affect the business is called a business risk, or at least a component of the business risk. Okay, so for audit risk, this is the risk that financial statements are materially incorrect. Even though the audit opinion states that the financial reports are free of any material misstatements, okay, audit risk may carry legal liability for a certified public accountancy firm performing audit work. Auditing firms carry malpractice insurance to manage audit risk and potential legal liability. So this is the risk that even if you have actually gathered evidence and have performed the necessary procedures, both uh, substantive tests and tests of control, you are still, or you can still be mistaken, or can still state that the financial statements are free from material misstatements, even if there is a material misstatements, or there is a material um, misstatement in the financial statement. So this is the risk. Um, So the question is, sir, so what's the purpose of the audit if there is still a risk that it can be materially incorrect? What do you think, guys? Why can there still be a risk that the financial statements are materially incorrect even if the auditor has already performed the audit work, and has actually stated that financial reports are free from any material misstatements? Why do you think there is still a risk, okay, for material misstatement? Yes, Reno, did you want to say something?
I think, sir, it is due to inherent risk, sir, because um, there's always be a human error.
Inherent risk, human error. How about the others? Why do you think there's still a risk for this audit risk actually falls under the this is the risk that auditors would face, okay, after performing their audit work. There is still a risk that the financial statements are incorrect or materially incorrect. Why is that? Or why do you think there is still a risk? Or do you think that after performing an audit, if you have performed the audit properly, you have done all the procedures necessary according to your risk assessment, according to your assessment of the work and the environment of the business, you have performed all the audit procedures as you have planned in your audit planning, do you think you have eliminated or you can eliminate audit risk? Or do you think it can't be eliminated? If it can't be eliminated, why? Anyone? No, sir, maybe because auditors only provide reasonable assurance. Okay, so yes, because auditors only provide reasonable assurance, we do not conduct 100% audit. Okay, we do some sampling, we perform our work, audit work, our audit procedures, but at the end of the day, it's only reasonable assurance. It's not absolute assurance of material of the fairness of the presentation of the financial statements. So yes, it cannot be zero audit risk. Okay, it cannot be eliminated. There is still an audit risk. Okay, so what are the components of the audit risk? It's the risk of material misstatement and detection risk. What do you mean by risk of material misstatement? The risk of material misstatement is the risk that the financial reports are materially incorrect before the audit is performed. Okay, that is at the start or before the audit is actually performed. There is already risk of material misstatement. Okay, and then we also have um, factors that can increase the risk of material misstatement on a financial statement level. Okay, one is if there is incompetence in the managerial incompetence. Second is poor oversight by the board of directors. Walang nagre-review by the management, di ba? And then inadequate accounting systems and records. Even the records are so scattered or it's too difficult for the auditors to actually gather all the information. Um, that's also a factor that could increase the risk of material misstatement. How do we ensure that everything is captured or everything is there or there is completeness if even the records we're not sure if everything is there. So inadequate accounting systems and records could also lead to material misstatement. Declining economic conditions, okay, because of some maneuvers, because of declining economic conditions or the economic conditions of the business could actually be a red flag or um, a note to the auditor that it could add or it could be a factor for material misstatement. And operation in rapidly changing industry. If there is a constant change or there is a constant update in the operation of the business because it needs to be at par with its competitors, there is also a risk of material misstatement. So these are the factors that affect the material misstatement of a financial statement. Again, risk of material misstatement is the risk that the financial statements are materially incorrect before the audit is performed. Okay? And risk of material misstatement at the financial statement level is the risk that certain risks could affect financial statements as a whole and potentially have a major impact on several assertions. Okay? It is vital to consider the risk of material misstatement at a financial statement level because of its potential to seriously hinder the auditor's ability to disclose an adequate unqualified audit opinion. Of course, if there's it does not always hinder, but it could hinder the auditor's ability to have an unqualified audit opinion. What an unqualified audit opinion is, we will deal with that when we get to the topic of audit opinion. But for now, it's enough for you to know that the risk of material misstatements in a financial statement um, is could affect, okay, the financial statements as a whole and potentially have a major impact on several assertions. It may not be all of the assertions, but it could affect some or several assertions, okay, depending on the accounts. Okay, and there are other factors that needs to be considered per account as well. So we will get to that as we go through this subject. Okay, so at an assertion level, the risk of material misstatement would be generally accepted or GAAS. Auditing standards require the auditor to assess the risk of material misstatement at the assertion level for all transaction classes, account balances, presentation, and attached disclosure. The auditor must develop the audit objectives for each individual assertion and perform audit procedures to accumulate the required audit evidence to achieve the audit objective. So, um, when you say develop audit objectives and for each individual assertion and perform audit procedures to accumulate the required audit evidence, you will actually design your audit depending on your assessment and your understanding. And then when you say develop objectives, when you perform a certain audit procedures, there is a certain objective that you want to achieve. Okay, so every time you perform, okay, and this is very important, when you perform a procedure, you should know what the objective is. And sometimes when you are planning, you will say, okay, I'm going to perform this procedure because I want to achieve this objective. And then later on, you realize, oh, because of this factor, this procedure can no longer be done, or it's not possible for me to actually perform this procedure, or even if I perform this procedure, it will not achieve this objective, then you should have alternative audit procedures. So it's important for you to understand that there is always an audit objective. my question always for my staff or for my people in the audit is, what is your objective? Because you should know what the objective is, because then you would be able to formulate or develop your audit procedures coming from the objective that you want to achieve. Okay, and it sometimes happen to, especially for the new ones, to be stuck in a certain procedure and then just go back and say, hey, I can't perform the procedure because this is not available, or this and this and this, and then I can always tell them what's your alternative audit procedure, because you cannot just say, I'm no longer auditing this one because I cannot perform this procedure. Okay, that's not a, that's we can't do that shortcut. You will always have to think for yourself what needs to be performed to achieve this objective. If your objective is accuracy, what will be your procedure? If your objective is completeness, what will be your procedure? Okay, now there is always an alternative procedure, or most of the time there is an alternative procedure. Okay, the risk of material misstatement of an assertion level is composed of an assessment of inherent risk and control risk. Okay, so composed of, again, inherent risk and control risk. So when you say inherent risk, this was mentioned by your classmate earlier, the auditor's statement regarding the client's susceptibility of an assertion to being materially misstated. This is before the consideration of the client's internal controls. While control risk is the auditor's assessment of the risk that material misstatement could be the product of an assertion and not be properly identified and corrected by the client's internal controls. So they are factors that will affect actually your audit risk. Okay, your audit risk, again, what is the audit risk? The risk that the financial statements could be materially incorrect even after the auditor has performed its audit work and has actually stated that the financial statements presents fairly and what it purports to be. But it's broken down also. We will have to consider what's the inherent risk, okay, and what's the controlled risk. Again, if you say inherent risk, okay, it's being the auditor's statement regarding the client's susceptibility of an assertion to being materially misstated. This is before the consideration of the client's internal controls. And of course, the control risk, okay, if the control risk is related to the internal control of the company. Even if the company has an internal control, okay, some very good businesses or well-established businesses has very good internal controls. But still, even with internal controls, there could still be a possibility of material misstatement where the client's internal controls could not correct or properly identify. Okay, so detection risk. Detection risk is the risk that the auditor's procedures do not detect a material misstatement. So it's still possible, okay, that you will not be able to detect the misstatement. Okay. For example, an auditor needs to perform a physical count of inventory and compare the results to the accounting records. This work is performed to prove the existence of inventory. If the auditor's test sample for the inventory count is insufficient, the extrapolation or to extrapolate out to the entire inventory, the detection risk is higher. Okay, so if you're going to just test a sample, okay, if there's like thousands or millions of volume um, of SKUs or inventory, okay, and then you'll just take like samples, okay, based on your audit procedures. You have identified some sample, and then on your sampling, everything that you have actually selected in your sampling were all accurate. But it doesn't mean you will then extrapolate or you will then conclude that based on the samples that you have conducted, that these inventories or SKUs were counted and they all match the records, and therefore you will say there is no material misstatement in the inventory. But could there still be a risk that some of the inventories are materially misstated, or that some of the inventories which were not part of your sample are not matching with the records? Yes, there is. And therefore, that's your detection risk. it could still exist, that the risk of material misstatement could still exist. And that's what you call detection risk. Okay? Your audit procedure did not detect the material misstatement. And in this case, especially if in this example, the inventory count is insufficient. Okay? Insufficient. Right. But in some companies, inventory counts are actually done 100%. And then the if the if the physical count does not match the record, there has to be an adjustment. Okay, and the physical count is a substantive procedure, okay, that you can perform, and it adds assurance to you and to you when you express an opinion regarding the assertion as to the inventory of the financial statement and the organization. Okay, so in the detection risk, the acceptable level of detection risk is a function of the desired level of overall audit risk and the assessed levels of inherent risk and control risk. Hence, detection risk can be changed at the discretion of the auditor. However, it should be emphasized that the auditor's preliminary assessments of inherent risk and control risk may change as the audit continues. So it could evolve. Um, at the start, of course, you had your, as we covered earlier, you'd have your understanding of the business. You have your inquiries with the management, observation. All those procedures for risk assessment would lead you to have an estimate of the control risk, right? And then the inherent risk. But when you actually perform your substantive test, you will still uncover some things or factors that you may have not considered when you were doing your assessment. So that evolves. And therefore, your inherent risk or control risk could also increase. Okay? An inherent risk could be per account and the inherent risk of the business or the industry itself. Okay? Um, is a factor. Okay, so control risk may change as the audit work continues. You will uncover, especially if you say, hey, there is internal control. You read the company's manual, okay, employees manual, and then you read the operations manual. Everything seems to be organized. So your assessment of control risk may be low. Okay, and then later on, you will discover that these manuals are not actually being implemented, or if they are implemented, they are implemented like it is optional. So your control risk assessment is now going to go up. Okay, so it changes. Okay, and it is a factor in the detection risk. So components of your risk of material misstatements or wrong, inherent risk, and control risk. Okay, so inherent risk is a susceptibility again of an account balance or class of transactions to misstatement that could be material individually or aggregated with misstatements in other balances or classes, assuming that there were no related internal controls. This is your inherent risk. Okay, so if you look at the account itself, it is inherently risky. Okay, that is the risk of susceptibility of an account balance or class of transactions to misstatement. Okay, that could be material individually or aggregated with misstatements in other balances or classes. Okay, and the account itself is risky. Okay, so that's inherent risk. And then control risk, okay, is the misstatement that could occur in an account balance or class of transactions that could be material individually or when aggregated with other misstatement in other misstated balances or classes. Okay, will not be prevented or detected and corrected on a timely basis by the accounting or internal control systems. These are the things that could still go wrong even with the employment or implementation of the internal control. Okay, so in summary, this will be your audit risk. Risk of material misstatements times your detection risk. Okay, your audit risk is Risk of material misstatements times detection risk. Okay? And your risk of material misstatement is affected by your inherent risk and control risk. Therefore, your audit risk is equal to inherent risk times your control risk times your detection risk. It's just substitution. Okay? Again, your audit risk is equal to your risk of material misstatements times your detection risk. But your risk of material misstatement can be broken down to your inherent risk and control risk. Okay, the factors that you consider in your risk of material misstatements is affected by your inherent risk and your control risk. Therefore, your audit risk as a whole is equal to your inherent risk your times your control risk times the detection risk. There is always the detection risk because, again, we only provide reasonable assurance in the conduct of our audit as to the fairness of the financial statements. Okay? And we only do sampling. We do not do 100% audit, and therefore we do not provide absolute assurance. Okay? So there is always that detection risk. And then we just broken down the we just break down the risk of material misstatement, your ROM, by replacing it with the inherent risk and control risk. Okay, what is again inherent risk is if there is no internal control or without the implementation of internal control, there is really inherently a risk of susceptibility of the account to be materially misstated. Your control risk is that even with the internal control in place and implemented, there is still a risk for you, okay, to have material misstatements in the assertions of your accounts in the financial statements. So, what's the difference between inherent risk and control risk? Inherent risk is in the account itself. Um, Inherently, when you say inherently, by nature or in its nature as the account, it is inherently risky. Can you give me an example of an inherently risky account, sir? Cash. Cash is inherently risky, especially if there is no internal control, right? Because cash is is highly susceptible to misappropriation in the sense that it is highly transferable. When you have money, you have cash, there is no need for you to prove ownership because it's a bearer instrument, right? So when you are the bearer of the instrument, remember, it's an instrument. The currency bill is an instrument. So when you go to a store and you pay using cash, the cashier would not ask you, is this really your money? Could it not be your company's money? No. As long as you're the bearer and you give that as a payment, that could be could be accepted as a legal tender. That will be that you can easily use that, even if it's not yours, so it's susceptible. So it's inherently risky as an account. Okay? What are, sir, those accounts that are, would you say, less inherently risky? Um, Less inherently risky would be relatively, would be, say, property, plant, and equipment. How could you misappropriate a land? If you know that the company owns the land, you cannot just build a house there as an employee. No, because you will be seen by the company. So it's less inherently risky. So I hope by now you understand what an inherently risky account or what accounts are would have high inherent risk, okay, versus what accounts would have lower inherent risk, okay. And then there's also your control risk. The risk that the controls implemented by the company will not be able to detect the material misstatement. Okay, that even if those are implemented, the material misstatement could still not be corrected. Okay, and therefore could still lead to material misstatement. Okay, so again, remember this one. This is very important. If someone asks you what an audit risk is, it's the risk that the auditor could still say the financial statements are free from material misstatements, even if there is a material misstatement in the financial statements. Or stated in another way, audit risk is the risk that the auditor is mistaken in expressing its opinion. Okay, that's your audit risk. And that is affected by two factors, your risk of material misstatements and detection risk. And your risk of material misstatement is affected by two factors, your inherent risk and your control risk. Therefore, if you break it down and you simplify the equation, you will say that audit risk is actually inherent risk times your control risk times your detection risk. Follow? So far?
Yes, sir.
Okay. All right. So, what is the assurance provided by audit? As you've mentioned earlier, an audit conducted in accordance with the Philippine Standards on Auditing provides only reasonable, not absolute, but reasonable assurance that the financial statements are free of material misstatement, whether caused by error or fraud. Okay? An auditor assesses control risk by considering internal control. There exists an inverse relationship between the control risk and the detection risk. Inverse relationship meaning if the control risk is high, detection risk is low. If the control risk is low, detection risk should be high. Okay? So that's what it's meant by inverse relationship. Okay? An auditor assesses control risk by considering its internal control. Okay. So, in risk assessment, inherent risk, which is susceptibility of an assertion to material misstatement in the absence of related controls, exists independently of the audit. Some assertions and related account balances sorry, and classes of transactions have greater level of inherent risk other than sorry, inherent risk than others. An auditor assesses control risk by considering internal control, and there exists an inverse relationship between, again, control risk and detection risk. The acceptable level of detection risk affects your substantive testing. Okay? As the acceptable level of detection risk decreases, the auditor changes the nature, timing, and extent of substantive tests to increase the assurance they provide. Okay, if there is a lower detection risk, okay, detection risk decreases, there is higher substantive test, higher level of substantive test to increase the assurance they provide. Therefore, there is an inverse relationship between the acceptable level of detection risk and substantive testing. If the detection risk is high, substantive testing is low. If the detection risk is low, substantive testing is high. Just remember that. What does it mean, sir? So if the detection risk is high and the substantive test is low, you may not have to perform as much procedures, or the level of sample is to be done is lower versus when the detection risk is is low, the substantive test is high. And hopefully later on in the application, we will be able to perform certain. Um, I have some tools that we can use in performing the random sampling and the sampling level using the tools that I do use in doing the audit. Uh, but it's enough for you right now to know that there is an inverse relationship between the detection risk and the substantive testing. Okay? So according to the standard, the auditor should consider the assessed levels of inherent and control risk in determining the nature, timing, and extent of substantive procedures required. To reduce audit risk to an acceptable level. The standard states that regardless of the assessed levels of inherent and control risks, the auditor should perform substantive procedures for material account balances and classes of transactions, which means that there is no substitute for substantive procedures. You always have to perform substantive procedures. You cannot entirely eliminate substantive procedures because that is your way of obtaining evidence, okay, in expressing an opinion for the financial statements. So you cannot entirely eliminate the substantive procedure. You can do tests of controls, but tests of controls are not substitute for your substantive procedures. Okay, we can have analytical procedures. This means evaluation of financial information, as I've said earlier, made by a study of plausible relationships among both financial and non-financial data. Okay, the basic premise underlying the application of analytical procedure is that plausible relationships among data may reasonably be expected to exist in the absence of known conditions to the contrary. So, say for example, when like you already know that that the in performing your analytical procedure, say you're auditing a restaurant, and you know that for restaurants the industry benchmark or the industry um, figures would have like food cost or direct cost as around 25 to 30% of the sales. So then, when you perform your analytical procedures, when the data would have like higher cost, that would give you an idea that this could have some material misstatements in this area because per industry, the restaurants would have around 25 to 30% direct cost. If the direct cost would have like 50 to 80%, then you'd have to examine what's in there. Is that really that high? So you could then adjust, okay, your substantive procedures based on your analytical procedures. Okay, a basic premise underlying the application of analytical procedure is that plausible relationships among data may reasonably be expected to exist in the absence of known conditions to the contrary. Of course, you could be wrong. Okay, your assumptions, because analytical procedures also have assumptions. Okay, assumptions of say prior knowledge or prior industry knowledge, but at the end of the day, the material misstatements needs to have your audit evidence, and your audit evidence may only be obtained when you perform your um, procedures. Okay, so analytical procedures are used for the following purposes. One, for risk assessment procedures to obtain an understanding of the entity and its environment. Two, as substantive test procedures when their application is, based on the auditor's judgment, more effective and efficient than test of details in reducing the risk of material misstatement. And three, as an overall review of financial statements at the completion stage of the audit engagement. Okay. Use sparingly number two, as substantive test procedures when their applications is, based on the auditor's judgment, more effective and efficient than test of details in reducing the risk of material misstatements. I often do not employ this one. I would be much comfortable if I do substantive procedures than or substantive tests than um, just analytical procedures. Okay, because after all, again, as I've said, analytical procedures would have some assumptions. Unless, of course, there is really another example for that is say there is say there's a distribution company and this distribution company would earn around 10% of the volume of sales, okay, as a net or as a gross margin. So when you do your analytical procedures, okay, for as long as it is within 10%, you will say, hey, okay, this is okay because you know that the gross margin states, but there is again a risk there for detection, okay? Because again, there is so much that you can uncover in terms of um, test of details. However, you also have to balance your audit procedures as to the efficiency and effectiveness of your procedures because you do not just audit one account. You will have to audit like all the accounts in the financial statements. So, as much as practicable, you balance the substantive test procedures with your analytical procedures in order for you to obtain reasonable assurance that the financial statements presents fairly, okay, or that the assertions of the management as to its financial statements are correct, okay, or fair, right? So analytical procedures applied as risk assessment procedures focus on enhancing the understanding of the entity's business. So in this level, as I've said, analytical procedures are used for any of these purposes. One, as risk assessment, two, as substantive test procedures, and three, as an overall review of the financial statements. So as a risk assessment, it is more focused on the understanding of the entity's business, identifying unusual transactions and events, identifying areas that may represent specific audit risks, and most often use data aggregated at a higher level. So, like you check the sales, you check the taxes, you check all other things that you think, or all other accounts that you think would be uh, material. Okay, so that's your analytical procedure as a risk assessment. Okay, okay. So what about internal control? You have mentioned that a lot of times earlier, sir. What is internal control? Okay, it is, according to the Philippine Standards in Auditing 315, states that internal control is designed and implemented to achieve the entity's objectives with regard to one, reliability of the financial reporting, two, effectiveness and efficiency of operations, three, compliance with applicable laws and regulations. Okay, so tatlo yan, reliability of financial reporting, effectiveness and efficiency of operations, compliance with applicable laws and regulations. So the internal control is really designed that way. Okay, so the goal of the internal control is to have a reliable financial report, to have effective and efficient operation, and to comply with applicable laws and regulations. That's why if there is a certain process, when you look at a certain entity or a business, you look at how it operates, and then you ask yourself, why are they doing this? Why are they doing this? Sometimes, if you are, especially if you are not an auditor, you wouldn't understand why things are being done that way. But if you are coming from an auditor's perspective, you're actually looking at it as a process, and then you'll look at it, what is it trying to prevent? Or what is it trying to achieve? Like, why does it have to always be a check? Why does it have to have a voucher? Why does it have to have a signatory? But all these things that you are performing as a process or procedure is part of the internal control. And the internal control is geared towards achieving one, reliability of financial reports, and two, maybe effectiveness and efficiency of the operations, or three, maybe to comply with the applicable laws and regulations. For example, you buy okay, fuel from a gasoline station, and then, like for example, Shell company, they always have that manner of conducting their business that they always have us to wait for the official receipt. Why? Because their company mandated all their employees that every purchase should be issued an official receipt. When you issue an official receipt, it ensures that the company actually records the sales. So that goes to the reliability of the financial reporting. Okay? And two, it complies with the applicable laws and regulations because the law, taxation law, says that everything should have an official receipt. You are even required to post in your business, in the prominent area of your business, conspicuous area of your business, that it be displayed, that ask for receipt plate, or ask for receipt. It's a big signage of ask for receipt. Okay, so these are the things that is aimed at, or that are aimed at in implementing an internal control. So then, in you implement an internal control, it's also important that you consider the effectiveness and efficiency of the operations. So there should be a proper balance, because sometimes when internal control as are created, especially for a specific purpose, sometimes it hinders the smooth transaction or the seamless conduct of the business. So most businesses would streamline their operations in such a way that there is control, but it does not hinder the business to operate seamlessly. Okay? So, but then again, for purposes of understanding what internal control is, this is a control designed and implemented to achieve the entity's objectives. Okay? The three objectives of the entity, namely the reliability of financial reporting, effectiveness and efficiency of the operations, and compliance with applicable laws and regulations. There are a lot of internal controls that you may not have been aware of that are internal controls, but were actually internal controls. But out of the point, as of this moment, you haven't realized yet. But because today you have studied internal control, you will then be able to spot a lot of internal control processes that is being applied in different organizations, businesses, and establishments. Even schools have internal controls. Okay, so you go to a bank, there is also internal control, right? So these are the things that you are going to learn, and you have to understand what internal control is. And I hope by now you understand what internal control is, right? Okay, so the use of IT allows an entity to apply consistently predefined business rules and perform complex calculations in processing large volumes of transactions and data. So this is very true. No? Even in accounting, most of the clients that we have no longer use manual accounting, books of accounting. We are already using different uh, tools, technological tools. The very least, Excel or spreadsheets, Google spreadsheets. And then IT could also enhance the timeliness, availability, and accuracy of information. Uh, if in the past or in the past age or era of accounting, there needs to be like 10 or 15 days um, lead time to see the financial statements of the company. Now, in my practice with the clients that we have in the company, we can actually provide the financial statements within the next 5 days from the end of the month. We'll be able to provide the financial statements because everything is synced through the system. So that enhances the timeliness, availability, and accuracy of information. And it facilitates the additional analysis of information. Some tools actually have, even QuickBooks or Zero already has their analytical tools that we can use in managing and in examining and reviewing the financial data. Enhance the IT also enhance the ability to monitor the performance of the entity's activities and its policies and procedures because the system, especially if it's an enterprise um, or an ERP, as you call, is uh, all encompassing, right? So it covers a lot of aspects in the business, not just in the finance side of the business. And then it reduces the risk that control will be circumvented because everything is transparent and can be seen. And it enhances the ability to achieve effective segregation of duties by implementing security controls in applications, databases, and operating systems. Okay, so yeah, the use of information technology really does all these. In risk assessment procedures to obtain an understanding of controls relevant to the audit include the following: um, inquiring of entity personnel, observing the application specific controls, inspecting documents and reports, and tracing transactions through the information system of financial reporting. Okay, so again, in risk assessment procedures to obtain understanding of controls, these are the things that you usually do. Okay, maybe you do not, you wouldn't appreciate this as much right now, but when you get to the actual audit, you will remember that you have covered this one. One of the things that you are going to encounter when you're doing your audit if you're going to go to the audit field or in the public practice, you're going to need all this. Okay, one thing that you can perform is inquire of entity personnel. I usually do this. Even before I do the proposals for the clients, I do the inquiry. Okay, I call it, that's my um, free assessment process. But the free assessment process is really inquiring of entity personnel, interviewing them, and then observing the application of specific controls. So in your inquiry, you will uncover some controls that they would say they have, and then you observe in the actual visit to the business, you will observe if those controls were actually being applied or implemented. And then, of course, inspecting documents and reports. We also do that. We borrow the reports when you're in the field, when we're in the office of the client. We ask, what is this report that you mentioned? Or can we see a sample of this one? And then we'll try to understand how the report is being done. And then tracing transactions through the information system of financial reporting. If they have a financial reporting system, you can trace both documents into the system, whether or not they are actually captured at random. You will be able to spot immediately the flaw in the implementation of the internal control. So these are the procedures that you can do in risk assessment for understanding of controls relevant to the audit. Okay. So what are the components of internal control? One, the internal control is composed of one, control environment, that is risk assessment process, the information system, including the related business processes relevant to financial reporting and communication. Okay, control activities and monitoring of controls. Okay, so let's do a little bit of exercise. What is one prominent business in Hingog City that you all know of, you are familiar of, and is able to visit or observe before we proceed? Just give me an entity, a company that you all have visited or know of and actually is familiar of how they operate their business. Can you think of one? Okay, Jollibee. Are you all familiar with Jollibee? At least most of you are familiar with Jollibee.
Yes, sir.
Okay, so let's look at Jollibee. What are the internal controls you can think of for Jollibee? What are the things that they do that you think is part of their internal control? An internal control is a process. So all transactions are in the system. What do you mean, Reno? All transactions are in the system. What do you mean by that? You mean to say that all transactions, all sales are being captured by their point of sale system, their POS, that all their cashier, like crew, are punching the sales in their system. Okay. All right. That's one of the internal control. What else? It's not just the sales. There are a lot of internal controls when you enter a Jollibee. What else? You will only be able to understand and appreciate this topic if you actually apply this in a real business or like look at a business in the eyes of an internal control assessor. So What else do you think are internal controls? That's one internal control, and that's the financial side. Internal control, it captures, okay, all transactions are in the system. What else can you think of as part of internal control of Jollibee? Are you there, guys? Hello?
Hello, sir. Included sa internal control ang inventory.
What inventory? What about inventory? Inventory is an account. So what about inventory? That is part of their internal control. Roshana.
Hello. Sir, akong pasabot nga inventory kay kanang example i-monitor ang ilang stocks within the day.
So you mean physical count of inventories. When you say inventory, if you are an accountant, inventory is not a process. Inventory is an account. Inventory is an asset. So what internal control related to inventory? You said the internal control with regard to inventory, sir, as to monitoring or checking the inventory levels at the end of the day. Yes, that's part of their internal control. You're correct. What do you mean with advertisement? What about advertisement? What's the internal control as to their advertisement? What do you mean?
At hello? Hello?
Yes.
Alright, ako ng
Yes, Pauline.
it ka ng compliance nila sila ay nag-double ba ko pala in sa ilang advertisement kay ka ng mga mag-comply sila sa laws and regulations kay basin sometimes ang ilahang mga advertisement kay basin dili necessary so like need nila nga tan-awon na siya nga aspect.
Are you saying they have that internal control, or are you saying that they need to have that internal control?
Kana dapat nga na sila internal control in terms of advertisement sila nga mag-comply sila sa one laws and regulation in terms of kanang bitawang silang i-use bitawang mga i-use yung mga feature nila bitawang mga videos. Inana kong pag-control.
Do you think they have that already, or do you think they don't have that?
Ay, nanay lahada na, sir.
Okay. Okay. I am not very familiar with the advertisement side or the rules on the advertisement side, although it can be observed for Jollibee advertisements, they are very much sensitive both for regulations and for how do you call that? Mm, in for humanity's sake, right? They have that sense, and they're very conscious of their advertisement. So yes, that's part of their internal control. What else? What else can you observe as part of the internal control of Jollibee? You have a Jollibee there, so you should at least have some observations how they conduct business, and that you can say, oh, this is part of internal control. What are some of the control activities that they have? How about the others? CCTV, sir, part of the internal control? Yes, it's part of control. Yes. And what objective is being achieved by the CCTV? What do you think? Remember our internal control, as we have covered earlier. Okay, these are the goals in the internal control, right? It's designed and implemented to achieve the entity's objectives with regard to reliability, effectiveness, and compliance. So, which one of these is achieved when you employ a CCTV camera? Monitoring of the working personnel, where does that fall in these three items? In the effectiveness and efficiency of the operations, right? Okay, yes, generals, about receipt issuances. When you issue receipts, that ensures that it is captured by the point of sale system and is therefore captured in the financial reports. That's in the reliability of the financial reports. Segregation of duties, sir, part what segregation of duties? Yes, that not everyone can access cash. That if you're from the kitchen, you do not go to the counter and receive payments. Yes, that's part of internal control. And that goes to one, efficiency and effectiveness of the operations, and two, it is also going to ensure financial reporting, or at least help in the accuracy of the financial reporting, because not everyone can have access to cash. So cash will not be susceptible to theft or misappropriation. What else? Jollibee. You imagine Jollibee. What else are there is an internal control. Consistency of the product served. Yes, that's also one. Um, okay, and that is being employed to what? Of course, effectiveness and efficiency. If you're one of the crew, you know that the weight of a large fries should always be this, and the weight of a regular fries should always be this. That a regular yum would have no cheese, and a cheeseburger would have a cheese. So the process itself, the consistency of the product served according to the menu, is part of the internal control. Correct. Okay, so these are components of internal control actually. The control environment, the entity's risk assessment process, the information system including the related business processes relevant to the financial reporting and communication, control activities, and monitoring of controls. Most of the things that we have discussed are control activities. Okay? But the components of internal control actually covers from the control environment to the monitoring of controls. It is not enough that you have the control activities. It is always necessary that you have the monitoring of controls. Okay? For example, the control activity is the installation and the turning on of the CCTV. But if no one reviews the CCTV, what kind of control is that? Okay? So internal control is composed of this. of these items, the control environment, the risk assessment process. Okay, so because the risk assessment, when you say for example, segregation of duties, the risk assessment could be that if everyone has access to cash in the counter, we'll have no idea who is taking cash because no, it's not going to be easy to have all the crew and just admit whoever touched the cash, right? But if the risk assessment say, hey, in order to avoid the risk of having a lot of people involved in cash, we'll have to segregate the duty. If you're from the kitchen, just focus in the kitchen, okay? If you are a crew, service crew, then your focus will be to clean up the tables, arrange the chairs, wipe up the tables when they're soiled, and everything except cash. And if you are the cashier, then you're the ones in charge receiving cash and giving change. Okay, so that's part. Okay, the information system, including the related business process relevant to financial reporting and communication. I know that there is a daily report that each of the managers, store managers, and cashiers would have to comply and report to the management, and that's part of the internal control and the control activities itself, and then the monitoring of controls. Are we doing this? Are we doing this? Are we performing this? Are we actually doing this? Implementing this? That's part of the internal control. Okay? Are policies that established what should do or not do in the company is part? Yes, policies are part of the internal control. Okay, so for control environments under PSA 315, it states that control environment includes the governance and management functions and attitudes, awareness, and actions of those charged with governance and management concerning the entity's internal control and its importance in the entity. So it's the control environment. Policies is part of it. The control environment sets the tone of the organization, influencing the control consciousness of its people. Okay? So control environment elements would be communication and informants of integrity and ethical values. You are bound, okay, by these commitment to competence. You should know that, you should have known that, or you should have the training to do that. Okay? You do not just go to the kitchen if you're not trained to what to do, how to prepare a regular yum, or how to handle the machines that they use there. Commitment to competence, participation by those charged with governance, management's philosophy and operating style, organizational structure, assignment of authority and responsibility, human resource policies and practices. All these are part of your control environment. Okay? So including your philosophy and operating style. If you follow a certain operational standard and manual, that's part of your control environment. You also have your organizational structure, who orders who, okay, who's going to be the lead is important. Okay? So we know that Jollibee stores are employing managers as well. There could be supervisors, right? So managers are responsible on um, managing the store, including their manpower, assignments, shifts. Okay, who's going to be on duty on these shifts if they are divided into multiple shifts in a day. Okay, so those are part of your environment. Okay, control environment elements. Okay, then we have the risk assessment process. According to PSA 315, the entity's risk assessment process forms the basis of how management determines the risks to be managed. For financial reporting purposes, an entity's risk assessment process includes how management identifies risks relevant to the preparation of financial statements, estimates their significance, assesses the likelihood of their occurrence, and decides upon actions to manage the team. For financial reporting purposes, an entity's risk assessment process includes um, ah, I think this is just duplicate. Okay, so um, What does it mean? Estimate their significance, assesses the likelihood of their occurrence, and decides upon actions to manage them. All these factors are being considered by the management, okay, in identifying the risks. Preparation of financial statements, okay, their significance, and then the likelihood of their occurrence, and how to manage the risk. In some companies, they even have a department that says risk management department, okay, which looks at the entire business risk of the organization. And then information system. The auditor should obtain an understanding of the information system relevant to the financial reporting to understand the classes of transactions, the procedures, the accounting records, how the information system captures events and conditions, and the financial reporting process used to prepare the entity's financial statements, including significant accounting estimates and disclosures. So it's important that if you encounter a business that employs information system, you also try and understand how the information system works for all these purposes. Okay. And then you have the control activities. Okay. So control activities are the policies and procedures that help ensure that management directives are carried out. They are intended to ensure that necessary actions are taken to address risks that threaten the achievements of the entity's objectives, and control activities have various objectives and are applied at various organizational and functional levels. Okay, so all these control activities are policies and procedures. Most of, as I've said earlier, most of the things that we have mentioned were part of the control activities. Okay, like punching in the POS. So it is a control activity so that it captures all the transactions of sales, okay, of the business. And then um, you said the consistency of the product served is also a control activity in terms of like there's a process like preparing a burger or preparing a chicken joy or preparing a spaghetti that every time this menu is served it's all going to be the same or it would look the same and it would taste the same. So that's part of their internal control and that's part of the control activities. There is a policy and a procedure. Okay? Specific control activities include those that relate to one, authorization, who approves who. Okay? And who can, example, it's especially sometimes when they void a transaction, they do not have access to void a transaction when they punched it. So who is authorized? Okay, it's part of the control activity is the authorization. Okay, they'll call their manager. Manager, can I please have your authorization to void this transaction? Sometimes though, you will not see the manager asking a lot of questions. They're just going to have their IDs swiped in the machine. But that is part of the control environment. That is part of the control activity. That not everyone has access to the voiding of transactions. Okay? Performance reviews is also part of control activity. Okay? How fast can you actually do your job? Okay? And how good are you at your job is part of a control activity. Information processing, okay, is part of your control activity. How is the information being processed? What reports do we generate? What reports do we check? Physical controls. What are physical controls? They have security guards that's part of the control, especially right now. If the store is already full as far as protocol is concerned, then they may have to restrict entry. That's part of physical control. Okay? And that is a control activity. Segregation of duties, again, it's a control activity as I've mentioned earlier. Control monitoring. Okay, so according to the standard, ongoing monitoring activities are built into the normal recurring activities of an entity and include regular management supervisory activities such as reviewing the purchasing function. Okay, so control monitoring is really for you to even the control monitoring. You do not just stop with the counting of the inventory. You also have to check if the inventories counted are actually are not yet obsolete and all of those things. So apart from just producing the physical count, you also have to ask how old are these inventories? Are these that's part of your monitoring. Like if it's already more than 1 year, is it not expired? Do we check the expiration dates? Right? So all those stuff can also be a factor and put in the controlled monitoring. Okay? Sana.
Kaya kami dito sa pick pa. Yan sir.
According to the standard again, it's an ongoing activity. Okay, it's an ongoing activity that is built into the normal recurring activities of an entity. Okay, so it is also important to ensure again to achieve the objective of the organization. So internal control system, an effective internal control system reduces the need for management to spend time reviewing exception reports on a day-to-day basis. And an entity's control system, if working effectively, should prevent as well as detect and correct exceptions. Exceptions meaning um, deviation from the process or errors. Control that are relevant to an audit pertain to the entity's objective of preparing financial statements for external purposes that are fairly presented in accordance with an applicable financial reporting framework. And because of inherent limitations of any system of internal control, even the most effective internal control cannot guarantee the elimination of employee fraud. Of course, because there is always a way, it's always a battle between the intelligence of the system that you have employed and the employee themselves. Okay, when you do have an internal control system, even how sophisticated the internal control system is, for if it will not entirely eliminate the employee fraud. Why? Because again, at some point you would have to grant access, authorization, and control to some of your employees. And if that employee is going to commit fraud, or some of the employees would connive to commit fraud, that is no longer part of the internal control system's intelligence. So there is still a possibility for the uh, susceptibility of the internal control system to be circumvented. But at least the risk is mitigated. Because, of course, if the internal control system is sophisticated, then the brains and the intelligence of those who would want to commit fraud should also be that complicated and sophisticated. Okay? All right. Um, can we pause for like 5 minutes break?
Okay, sir.
Okay.